Project management and invoicing software. An overview of the financial statements. Very few, in fact, perhaps no other project management applications that I've seen also include the accounting aspect. Yet, as I pointed out in my previous post, the accounting aspect is an integral part of project management and vice versa. We have our clients and we have our projects, and then within each project, we're managing everything that has to be done for those projects and for those clients. And along the way, it follows very organically that you have expenses that need to be reimbursed and activities that need to be completed, and in many cases, time that needs to be tracked for those activities, such that you can bill that stuff back to your clients. Even if you're charging a flat fee, most engineering, architectural, service-based businesses still want to get a sense of how long it's taking them to complete the work so that they can get a sense of whether or not it's being done efficiently and what can be done to be able to fill in more jobs and so on and so forth. So let's take a look at BillQuick Online and the accounting reports that are offered here. If I go into my accounting center, or rather if I go into the report center, then you'll see the accounting reports. And we're going to run an accrual basis balance sheet. And we'll run it for last year. The date is already set because I set it that way on a trial, just making sure that things were working the way I had expected. So I'm going to view that one. So we have our balance sheet. I'm going to move that aside for a second. Next, we're going to run our profit and loss, also accrual. And again, for prior year, 2016, I'll choose view. And last, but definitely not least, we're going to run the statement of cash flows. And this has to be accrual. Statement of cash flows doesn't sort of exist on a cash basis. And the reason I'm running them for accrual is you might file your taxes on a cash basis, but everything else for a business needs to be done on an accrual basis. You have to analyze the business on an accrual basis. These are your three basic financial statements for any business, and all three really need to be looked at. The problem is most businesses look at or primarily focus on this one, which is the profit and loss, which answers the classic question, how much money did I make? But I would argue that you're not asking the right question, perhaps, or you're not asking enough questions, because of course it's important to make a profit, but perhaps the better question to ask is, how much money is my business worth, which is what we're getting at with the balance sheet. And at the end of the day, we want to see what's that equity section total up to. The net income from the profit and loss closes out to the equity section of the balance sheet here. And the idea is that if I operated at a loss, that reduces the value of my business. If I generate a profit, that increases the value of my business. Now let's take a look at where these numbers come from. Here's the profit and loss. Now the net income here says $766,437.21. So if you're paying attention, you'll see that doesn't quite add up to the $1,660. Here's the difference. We have retained earnings of $768,097.21. So each month, the net income cumulatively closes out to retained earnings. The net income or losses from the current month. When you add these two together, the $768 minus the $1,660, you will get the net income for the period, which is $766,431 with 21 cents. Another important thing to notice, if we go back to the top of the balance sheet here and we look at the total cash, $195,714.30, and then if we look at the statement of cash flows and the balance that it arrives at for the end of the year, it might be confusing because the cash at the end of the period says $322,749.30. The reason is because undeposited funds is considered the same as cash. So you take this $127,035 plus this $195,714.30, and you will get your grand total of $322,749.30. That's how you get the right ending balance. So it's important to understand how these financial statements relate to one another and how they tie in and how things flow from one place to the other. And here on the statement of cash flows, we start with our net income and we essentially reconcile our accrual basis net income to cash. What accounts for this difference? It's the changes. This isn't the balance in accounts receivable. This is how much accounts receivable changed during the period. Same thing with legacy payments, accounts payable, customer deposits, and retainers. These are not the balances in these accounts. These are the changes to the balances in these accounts. And for that matter, these are things that happen to cash that weren't reflected in net income. So an increase in accounts receivable means we have income included in net income that we haven't been paid for yet. So that increase needs to be subtracted out to arrive at cash, right? And that's an asset account. Liability accounts work the exact opposite. Right? And then down below we have financing activities, which essentially is the owner contributions and distributions that may be going on where I contribute my own cash into the business. Here it looks like we've added $175,000 into the business for working capital or perhaps to get the business started out. And the point here, and the reason this becomes, I think, one of the most important financial statements to understand, even though it's the least understood, is because this gives me an indication here that while we did have $150,000 coming in from operating activities, we had more than that come in from financing activities. And this should raise a question: does this company have the ability to continue as a going concern, or doesn't it? If the cash flows don't start shifting or substantially coming from operating activities, then we may have a problem because there's only so much we're going to be able to invest or borrow into the business or loan into the business rather in order to keep that business going. That money, those sources of money other than from operations are eventually going to dry up. The bank's only going to lend us so much. The owner can only contribute so much. Eventually the money is going to run out unless we start generating profits and getting our operating cash flows from there. That, my friends, is a quick overview on everything you should understand at a high level about the three major financial statements: the statement of cash flows, the balance sheet, and of course the profit and loss, with which you're probably most familiar. As always, I hope you learned something and had some fun along the way. I hope you're having an absolutely fantastic day, and I look forward to seeing you on the web.